Hello, welcome to this lecture session 15. In this session, we shall discuss about the detail of certain items of the asset side and how the asset will look like in the published balance sheet of business entity. Let me take you to this screenshot of Reliance Industries Limited. So Reliance Industries Limited, the asset first will appear into two categories. One is a non-current assets. Under non-current assets, if you look at it, property, plant and machinery, capital work in progress, intangible assets under development, financial assets, investment loans, other non-current assets, and total non-current assets. What is the meaning of, and details we can get it in notes. What is the meaning of non-current assets? The meaning of non-current assets is that it would either be used for more than 1 year to generate sales, or it would be converted into cash after 1 year. Now, if you look at it, property, plant and equipment, this capital work in progress, this would be used for more than 1 year for generating sales. This investment or loans which is given, the money would be realized after 1 year. That is why it is classified under non-current assets. Now, in the case of the property, plant and equipment, net value would be presented in the balance sheet. Now, capital work in progress means fixed assets under construction and yet to be completed. Now, if a company has got continuously building up capital work in progress, but not converting into fixed assets, that may not be a good sign. Investment means RIL has given the money, and against that, it has got financial securities which are tradable in the market. Now, financial securities are of two types. One is tradable, one is a non-tradable. Now, when you go to the bank and give the money, bank will issue fixed deposit receipts. That is not sellable in the market. Another part is that when you are buying a shares and the shares you can trade in the market. So financial securities are of two types. One is tradable, one is a non-tradable. So when Reliance is investing, it is getting financial securities. In case the financial securities are tradable, it will be classified under the head investment. And if it is non-tradable, it will be classified under the head loans. Non-current assets means whatever the money which is given, and money would be realized after 1 year. Now we will see the details. If you want to know the details, we have to go to the notes. Let me show it to the notes. Property, plant and machinery, this gives you the notes details. So in the case of the note details, as we have discussed, we can get the gross block. Let us look at it. This is the gross block. Similarly, we can also find out the accumulated depreciation. So this is the accumulated depreciation. Now this depreciation means since inception till the date, whatever the assets in the balance sheet for that depreciation. Then we find out the net block. Similar for intangible assets. In the case of an intangible assets, instead of depreciation here, this amount is amortization. So that's the net intangible asset should be there. So next, what we look at, capital work in progress. If you can look at it, this is capital work in progress. So here, if you want to know the detail of property, plant and machinery, you can go to the notes and you can find out. If you look at it, investment, we are measuring the investment unit and amount. So how much amount we have, shares we have bought, loans we have given, those things will come. So in the case of an investment, we get more details of unit and amount in the notes. Now, next very important point, investment will be categorized into different categories. Now, one is amortized cost, one is comprehensive income, one is through profit and loss to the profit and loss. What is this difference? Suppose, for example, this is the investment which is actually made at 124,111. Now, this is March 31st, 2019. Suppose in the month of October, the value of this investment has become 120. If you can recollect, asset side value is going down. So you have to pass a credit entry here. So that means if the value has to be brought down by say 120,000 crores, 1,20,000 crores. All figures are in crores. So if the value goes down to 1,20,000 crores, to reflect this value, a credit entry has to be passed in the balance sheet on the asset side. So there has to be a debit. This debit is in P&L. So if the company classifies the financial assets at cost, even the value goes down, it need not to do the mark to market. So any reduction in value will not result in impacts in the either profit and loss or balance sheet. Now in the case, another investment is through comprehensive income. So 90,441. Suppose the value becomes 80,000. So in this case, there will be reduction in value of 10,441. So there will be credit entry here, 10,441. The debit will not go to the P&L. Debit will go to the directly into the retained earning, or what is called reserves and surplus account. So that is also called other equity. We'll discuss slightly later on. So if the investment in the case of the categorized as the fair value through other comprehensive income, any reduction in value would be arrived at by passing a credit entry on the asset side and debit entry on the balance sheet under the head called other equity, which is nothing but the one of the part is the retained earning. We'll discuss in detail later on. Now in this case, now it is 250. Now through P&L, fair value through P&L means if there is a reduction in value, so definitely the credit entry has to be passed on the asset side. Corresponding debit will go to the P&L, profit and loss account. So this is a very important dimensions which I am bringing in. So depending on what classification investment would be there, the profit and loss of the entity will get impacted. Otherwise, what will happen? If it is at cost, no valuation has to be carried out. No mark to market has to be carried out. Next, inventories. As we know, inventory consists of raw material, WIP, finished goods, stock in trade, spares. So there's not much of a detail has to be made. We have already discussed. Next is the investment current. Current investment means when the Reliance is investing and the money has to come back within 1 year. That is called current investment. Same way we can classify it under the fair value through comprehensive income or fair value through profit and loss. Then we talk about receivable. If the receivable is 12,110. So in that case, if we need to know more detail about it, the notes will say how much receivable is bad and how much receivable is, or not bad, how much receivable is old for a particular period or how much receivable is current. So what we have discussed about the certain component of the asset side from a published balance sheet. So this will give you an idea about how the published balance sheet will look like. In the next lecture session, we shall discuss about the liability part, other composition. Thank you very much for watching this video.